Welcome to the Omz Property Podcast, your go-to guide for navigating the world of property investing. I'm your host, and in every episode, I sit down with property investors, developers, and top industry experts to share their insights, strategies, and inspiring stories. Whether you're a seasoned investor or just getting started, join us as we explore all aspects of building wealth through property. Welcome back to another episode of the Omz Property Podcast. Today, we're going to talk about development finance, and I'm privileged to have a guest here with me, Michael from Avamore. How are you doing?
Good to see you, Omar. How's it going?
Very good, thank you. Cheers for coming in.
No, it's a pleasure.
I know you've got a podcast as well, so you're pretty familiar with this sort of setup and speaking with people about stuff, I guess.
Yeah. It's always good fun to be on the other side of the microphone and being the one answering the questions. I think it's actually quite hard being the guest and having to think up the questions and keep the conversation going.
Well, you're the first guest I've got in today, so you've got an early morning start. And I hear your brain typically fires better first thing in the morning, so let's see if that transpires. We were talking a little bit just before we started about skiing, because I believe you've just come back off a skiing holiday.
Yeah.
And that sounds like you had a great time. Do you find lots of people in property ski, or is that just something, because I seem to speak to quite a few people. I know there's like prop ski and all these things where people actually go off and do property and skiing at the same time, but
yeah. I think there's definitely some good networking opportunities on the skiing front.
Sure.
Property historically, especially in the old school agency days, was quite blue-blooded, and your Tarquins and the like. They would typically take little Johnny and Jemima for their annual ski trip to Val d'Isère or whatever. Yeah. But I think the property industry is becoming a little bit more. I think it's becoming a little bit broader in terms of the people that are doing it. So I think so. A lot of property people would rather be in a CrossFit gym or whatever than on a ski slope.
Yeah, amazing. Well, if we could start off just by you giving a brief background as to who you are, what you do, and a bit about Avamore as well, if you can, please.
Yeah, so my name is Michael Dean. I'm a co-founder of Avamore Capital. You can also say Avamore if you're really posh. Avamore will be 10 years old this year. It was co-founded by myself and Zaher Mirza. We also had a third co-founder called Nick Petkov. Nick left the business about 4 years ago to set up a smaller lending business. My background has been in property, so I've been 20 plus years in property. I started off my career as a surveyor at a company called Cushman & Wakefield, specialised in central London property, both leasing and investment. Then I went and moved to a private equity house just after Lehman Brothers crashed. I was there for about 2.5 years, mainly doing debt restructurings. I then went and worked for a family office, which actually happened to be my father-in-law's family office. Helped him set that up, helped him exit some businesses. We reinvested the cash into commercial property investments, mainly office buildings around the M25, which we then got PD consent for and sold to resi developers. And during that time, we were fully invested. I started doing a bit of capital advisory work on the side, met Zaher, and basically from that, Avamore was born. We looked at a couple of deals together, and then started lending together. Family capital. Time moved on. We got a bit of a track record. Institutions wanted to come and back us. In addition to sort of private family office club deals that we did with other high net worths. I guess 10 years, nearly £1 billion later of lending, nearly a £200 million loan book, 25 staff, zero capital losses. We've been doing a broad range of I suppose non-regulated short-term finance, but mainly focused in the refurbishment and bridging space. Doing smaller ground-up developments, and then we also have a specialist product for part complete development. We used to call it finish and exit, but now, because the rest of the market stole the phrase, we rebranded it to part complete development. So, anything with from golden brick upwards, we can step into a development site, take out an existing lender, or just help a builder who maybe bought a site in cash, needs to release some cash and get the build finished. That's probably our flagship signature product.
Sorry to interrupt, but I just wanted to introduce a sponsor of the channel. Trinity Finance is a directly authorised FCA regulated mortgage brokerage. Founded in 2015 with over 30 mortgage brokers, we're really well placed to help you with all your property finance needs. Starting with first-time buyers and those moving home, we also help people remortgaging residential and buy-to-let property. Alongside that, we specialise in ground-up development, commercial lending, HMO funding, mezzanine, auction, and also your traditional buy-to-let. If that's of interest, get in contact with us via email at info@trinityfinance.co.uk, or you can give us a ring on 01322 907 000, and we look forward to hearing from you. So we do some business with Avamore in terms of introducing some of our developer clients that are looking for funding, and as well as some other lenders, I might say, and we're not for any minute giving financial advice in this particular podcast here. But could we dive into a bit of a conversation about what makes you different from some of the other, perhaps larger, more bank-type institutions that are offering development finance? So what's the difference between Avamore and, say, I don't know, Shawbrook Bank or LendInvest or one of these type of lenders?
Yeah, I guess the contrast between us and Shawbrook is probably more appropriate. I think LendInvest are probably a bit more similar, but now being a large institution still... they still have their differences. I think the key thing is that it's our size, it's our management structure as well. We're very horizontally, arranged. We've got a very horizontal management structure. So, all 25 of us sit in an open plan office together, and daily to make credit decisions. We can make formal credit decisions to lend in less than 24 hours as soon as we've got the information in or submitted through our portal. We have credit meetings twice a day. You'll find with banks their ability to sit and have a conversation, a credit-backed conversation, isn't always as easy. I think the other thing is that you'd be surprised, despite the size of someone like Shawbrook, that ultimately the size of the team that's doing development finance won't be that different in terms of how big it is. But the amount of money that they've got to lend is significantly larger, which means that their ability to, and it pretty much costs the same to process a £250,000 case as it does, say, a £4 or £5 million case. So understandably, if you're Shawbrook, with your large amount of money that you need to deploy, you've got to focus on larger cases, because if to use a cricketing analogy, they need to be scoring in 4s and 6s. We can get it done in 1s and 2s. So we can do a £250,000 or £300,000 ground up development deal, because we can effectively devote more resources more efficiently than they can. That's ultimately what it boils down to. Obviously, we've got a more streamlined decision making process, but fundamentally, it's that we've got the ability to do a smaller deal in a way that they probably can't do a complex smaller deal, because they need to be focused on larger, probably less complex cases.
I've seen that firsthand, actually. So you regularly get clients of mine, new and old clients that perhaps are sometimes scaling up and doing bigger projects, and regularly the kind of more well-known development funding providers will have £1 million minimum loan size. Yeah. So, anything under that level is just not of interest, and there's really no movement on that for them. You might find some are capped at 500, 750, a million. I think there's even a few that, unless it's 2 million and above, they're just not interested at all. And I have seen Avamore quite often will, do something that's 500k. Yeah. And sometimes have some other issues, perhaps experience and location and things like that as well. So apart from loan size, your ability to move really quickly, the credit committee meetings can be daily. Some of these lenders will take a week to make a decision, get credit back terms. Pricing, what would you say about pricing? And what would you also, as well as pricing, say about criteria? So experience, location, types of projects that people are doing. How do you compare?
Yeah, so these are really good questions, important questions for clients to contend with, because price wise we're not as cheap as the banks, but actually we're not that much more expensive either. I always used to I always used to joke about the how expensive is cheap money that never arrives. At the end of the day, you need your lender to perform for you, and paying an extra 1% a year, it sometimes it can be a price worth paying, or 0.5% or whatever the difference is. Because a lot of the time, and again, I don't want to go off on a rant, but a lot of the time the headline rate on a loan isn't the only cost to a borrower. You've obviously got arrangement fees on the way in, you've got exit fees on the way out. I think sometimes borrowers can become quite fixated on the rate, but you've got to remember a development loan is for 12 months, 15, 18, 24 months. It's a short-term product, and a lot of the time, especially if you're funding the development works in arrears, you're not even paying that rate for 2 years or 18 months. You might only be paying it on a blended basis for 9 months or 12 months. So as a consequence of that, it's really important for clients not to be too fixated on rate, but actually to look at the total costs. But you also have to remember, as a developer, your finance costs as a proportion to your total costs are still relatively small. If you look at a development appraisal, what are the big costs? The land price and the build costs. The finance costs are, generally speaking, a percentage of that. Probably, sub 10% of the total cost will be finance costs, if that. And so, you've really got to focus on, actually leverage, and then also flexibility. Something actually wants to support your project. So one of the things that will set us apart from the early days was our willingness to be open-minded about experience. So, for example, the types of people that we really like, and we often have fairly heated debates with our funders about this, is that we really like actually clients who are not that experienced, but that, let's just say they've got a big buy-to-let portfolio, they've done lots of light refurbishments, and then they've got 1, 2, 3 million pounds worth of net assets in a buy-to-let portfolio, but they don't have any ground-up development experience. So we said to them, that's fine. We're actually very happy to support you on a ground-up project. What we'd like you to do is maybe team up with an experienced contractor, or project manager, and actually, if the deal stacks up, we'll still be happy to support you. Alternatively, it could be someone who's been a contractor for the last 10 years, really knows how to build, but hasn't actually done it many times as a principal developer themselves. Now, in both of those scenarios, those clients would be excluded from, I'm not going to say Shawbrook wouldn't deal with them, but I'm just saying that most challenger banks would be like, this is not a client profile that we want to deal with unless, let's say, the leverage was really low. But at that point, is that really helping the client? So consequently, actually, our ability to be a bit more open-minded about experience can make a difference. The same goes for a scheme. Obviously, we talked about deal size, but types of schemes, types of locations, maybe you can look at something that's a bit more rural. Again, we talked about the part complete development product. A lot of the time, people don't want to use any finance, and they buy sites with cash, and then they'll just use cash from sales or whatever else, other sources to fund the works. But sometimes sales, particularly in the current market, get a bit sticky, so there's cash not necessarily rolling in, or those other sources of cash that they were getting it from, they dry up. So what does the client do? Well, we give the opportunity for that client to, halfway through the build, to actually access finance to replenish some of the cash that they had, and then also give them the cash to get the thing finished. Now, a lot of lenders see that as highly risky, and you can kind of understand why they see it that way. But we really understand the risks, and we know how to mitigate for those risks really well, so we can actually support those clients. So again, there's lots of different nuances. There's over 300 specialist finance businesses minimum that are currently operating. We all have to find our niches. Yeah. And certainly one of our biggest niches is our ability to be flexible on experience, to be flexible at when we step into a project. And then the last thing, which I think is really pertinent in the current climate, is that it's very hard for developers and landowners to agree on what the appropriate land value is for a site right now. And so a lot of nifty developers are saying to landowners, look, I'll pay you this X because this is what I think the land's worth. But I understand that you value the land higher. So what we're going to do is I'll pay you this now, and then I'll pay you the residue out of sales, provided the sales, the GDV, reaches a certain level. So let's say they pay them, we're actually hopefully closing on something today. So the landowner's getting, I don't know, 600,000, 800,000 pounds on day one, and maybe they get 400k at the back end when both of the units sell. You know, and the developer still makes their margin, but it means that they're not having to pay that extra bit of land up front, and also crucially, they're not paying interest on that portion as well. So that landowner's interest is subordinated to us. But fundamentally, if the landowner believes in the story and actually believes that the land is worth what they think it is, that they've got slightly more aligned interests with the landowner. Now, most lenders do not like that structure. Most lenders are very, especially in the challenger bank space, and what I'd call sort of less specialist, if you know what I mean. If you know what I mean, and I know you do, and maybe your audience doesn't, but they don't like these kind of structures. They don't like, because there's two parts to that. One, they want a clean. They want a clean structure because they don't want anyone else in the mix that they have to have an argument with if the loan goes into receivership or they have to off to enforce. But the second side of it also goes down to the resourcing point, which is that they want simple, clean deals. They want their professionals to spoon feed them, and then they just want to rubber stamp it, write a credit paper and rubber stamp it, and put the money out the door. Yeah. And I think that's one of the key. That's also a very key difference.
That's really interesting, and you've got me thinking about a few things really. And the first one is there's a current deal that I've got, which is going through with Avamore at the moment for one of my clients, and without giving away any specifics about the client or anything like that, of course, don't want to do that, but I think there's a bit of a learning curve in it actually. And so even from my own perspective of writing business for 15 odd years and heading up my mortgage business, we have had a case where this client came to me about a year and a half ago and asked for funding, and I actually got him some terms from various different lenders, Avamore not being one of them, sorry about that. But what happened is he was influenced by someone else to take a loan from a peer-to-peer lender. I won't name the peer-to-peer lender, but the main reason to go to that peer-to-peer lender was purely leverage. He had to put less money into the deal. They seemed very keen and willing to lend. The pricing wasn't actually better than what I'd got him terms for, but he decided to proceed with that particular application. And without giving away, again, specifics, we're 15, 16 months down the line and the scheme's not been built and not been complete. It's part complete, but it's still got a fair way to go. So the challenges for me at the time were who's going to take over refinancing a peer-to-peer lender. And you'll probably know a lot of the banks, they don't want to refinance peer-to-peer lenders because they see perhaps that peer-to-peer lender may have been more relaxed with criteria or perhaps leveraged higher than they would want to leverage. And so they sort of have these rules where unless it's a traditional bank that's lent on, that we don't want to step in as a second time lender. So that was the first challenge. The second one, it's a part complete scheme. So we've got foundations and substructure pretty much mainly done. A lot of planning conditions discharged, and the site's good, but for lots of lenders, they can't see perhaps any of the hurdles that may or may not have been overcome. And has it been built correctly, and all these sorts of things. So again, it doesn't tick the box. Computer says no, and some of the traditional lenders have also said no. And then thirdly on this one was actually my client's experience. So he had completed some house to flat conversions and had decent assets and liabilities, was in quite a good, well-paid job as well. So, on paper looked good, but from an experience perspective, have never completed anything similar to this sort of scheme. Had a really good contractor who'd done many projects like that. But speaking to circa 30 to 40 development funding lenders, we narrowed it down to a handful. And Avamore were one of those that were willing to step in and do it. And you took a pragmatic approach. So it went to credit committee really quickly. Yeah. There were things that you had to do to mitigate risk. So leverage wasn't as high as the peer-to-peer lender, understandably, but were able to lend very quickly in terms of making decisions, and QS instructed, surveyor instructed, solicitors ready to go. So I just was quite impressed with how quickly that all went, especially when you compare that to some of the other lenders where it just really drags to actually get a decision. And when someone's got finance expiring, they need certainty, don't they? The last thing they want is their existing term facility to run out, and then they're thinking, right, how am I actually going to refinance it? So there was a lot of learning curves in that deal actually with Avamore, and you stepped in and have been fantastic. Although it's not complete yet at the time of recording this episode, it's been great to get to this point and actually overcome a lot of those hurdles. So thank you for supporting us on that one, I suppose.
Of course, no, and you know, of course, we'd like to do more of that with you and other stuff. But you know, to the point around pragmatism, like at the end of the day, like we want to do deals, and you know, like we're very frustrated on a deal that you're not involved with, but where the client really was desperate to complete as quickly as possible. The building's got subsidence, and we want to try and take a pragmatic view, but ultimately, because of the leverage that they need, we need to have a couple of reports, ground investigation reports, to give us the comfort that we're not going to find ourselves in a bit of a pickle, 3 or 4 months down the line.
Sure.
But on the other hand, you know, the thing that we've been lending for 10 years, and you know, we've not had any capital losses, and the things that have. But of the last 2-3 years, actually, we've started to have more challenges in terms of defaults and and issues with credit in live schemes.
I was going to jump in and start asking you about this, because this is something I was quite interested in. I've seen that, I suppose, in regards to, say, build costs, so because this is completely linked to what you're saying, is I found before a developer, perhaps previously a builder or a main contractor, now moving into development themselves, they could build stuff out at a certain price. And I would typically find when I went to a funder and said, look, they can build this out at £2,000 a square metre, there was less pushback from the funder to say, sorry, we don't like that figure and we want to stress this at £220 a square foot or £2,500 a square metre. Now I'm finding all the funders are actually saying, no, you might be able to do it at that, but we want to stress it at this in case we have to step in. So from Avamore's perspective, like, how are you seeing many deals go wrong, and how many are you having to step in and sort out, I suppose?
Well, I'm going to give you two answers. The first is that at the origination level, if someone is an experienced developer builder, which I think is at the moment probably they're our favourite developers to back, the monitoring surveyor, they'll give their figures to the monitoring surveyor. As long as the figures are generally within the BCIS lower quartile, we'd be happy to support that. And also, like, there's not too many provisional items, i.e., you know, like they've got quotes for the windows, and they've got quotes for, you know, a load of the fixtures and the fittings, the things that are expensive that can really cause really big cost overruns. If they've got all of that, and maybe the ground, you know, they've got the ground investigations and blah blah blah, like we can probably go with the client's build costs and support those. If they don't, you know, if they're working with a third party contractor, and if they are less experienced and blah blah blah, then you have to be a bit more cautious. But yeah, stepping into developments midway through, we've had to do that a few times over the last couple of years. To say that some of the stuff has been complex doesn't even begin to describe it. We've got one where it's now being resolved, as in physically we've stepped in. We've got a joint venture partner who are finishing the flats off for us, but we supported an Israeli fund who were building, had a big pipeline of developments around London and the southeast. We got 2 schemes with them, or should we say, we still have them, they don't. And they, I mean, can I swear?
Go for it,
I mean, because it kind of deserves it. It's like, you know, the 2 words that come to mind, clusterfuck and shit show. Like, you know, and you know, you kind of, you know, you got to square that. Where
did that start to go wrong? Do you mind? Because I think it might be really good learning. I know you might not want to give away specifics.
No. I know. As in, where did it go wrong? It's not that the developer wasn't experienced, but they had big problems with their contractors. They had big problems with their cash flow. They were over trading massively. You know, they definitely tried to run before they could walk, and they put themselves under a lot of pressure because I think their strategy was to build flats to sell to first-time buyers, Help to Buy, but I think what happened was, it also coincided with 22, 23, that massive ramp in construction cost inflation. So I think there was just a big liquidity pinch, issues with the contractor, like perfect storm. And then just to make matters worse, so one of the schemes in Northwest London, they had something like 23 out of 39 flats had been sold on Help to Buy, and they needed to be finished in advance of the Help to Buy deadline. However, the rest, those flats got signed off for building control and were able to be sold. The rest of the building wasn't even wind and watertight. And this, and I mean, just, and then, so when we ended up taking it over, administrators were appointed. We had long leaseholders who had taken loans from the Department of Housing and Communities Local Government, basically Angela Rayner, and we had to move them out of the building because effectively the rest of the building was unsafe, and if you remember late summer, early autumn last year, it rained incessantly, but you had live electrics with a building with crazy water ingress. So although we're not the administrators, me and Zaher feeling personally liable, if something happens to someone, we would not be able to live with ourselves. We're picturing we're going to have to go in front of go into Parliament and talk, and be grilled by some select committee. I mean, obviously I'm catastrophizing, wouldn't ever come to that. But so we took our responsibilities really seriously. So we in our funder, we spent, hundreds of thousands of pounds relocating residents out of the building. And then to make matters worse, the administrator appointed a project manager who kind of just, I'm going to be generous and say the cost control during that time was abysmal. So we had to work really hard to get the building safe, unwind these arrangements with this project manager, and then do a deal with a contractor to basically make the building safe, and then finish the flats off, finish the whole of the building off. We got the residents back in relatively quickly. Did finish what we called life safety works. Got the residents back in the building, and then now the contractor is smashing it out the park, getting the
amazing,
getting the thing finished. But it was not fun.
Oh god,
it was not fun. And the worst thing is actually because the way that the deal was structured by one of the team members who's not with the firm anymore. None of the directors, the principals of the company that were doing the development had a personal guarantee, which is actually a rarity. It's about the only time we've ever done it. And so, and I still connect with one of the directors on Instagram, and I see that they're having a whale of a time. They're having, that we've had to, I mean, particularly Zaher has resolved so much shit. And on a 10 million plus GDV scheme. Yeah. He's resolved so much shit, I've been along for the ride, definitely a couple of inches of my hairline have been lost as a result of that.
So you heard it here first. If you're listening and watching this, that's the way not to do property development, isn't it? It's literally everything that could have gone wrong. And then you guys having to step in to try and salvage something which is potentially causing people's lives to be at risk. So on that then, talking about contractors, now it sounds like this particular borrower perhaps wasn't the contractor themselves. I would imagine they just literally outsourced to a main contractor, and that's probably where a lot of it went wrong at the beginning, was that perhaps the speed and not meeting the timeline of which they were supposed to finish these flats. Do you find that is one of the key things where things go wrong, is actually a lot of it's to do with the contractor rather than the developer themselves, or is it a mixture of both? There are
a myriad of reasons why a development can go wrong. I think the chief amongst them is actually just the developer paying too much for the land. That's like that. Yeah. That's just like that. That's a root of all ills. But putting that to one side, the contractor can be a problem if you have a contractor with a weak balance sheet, a contractor who's overtrading, or a contractor who is overcommitted in terms of they've committed to a price on the scheme, but has that they shouldn't have committed to. Basically, they tried to cut their margins to win business. These are kind of recipes of disaster on the contractor side. The developer who, if the developer's overtrading, that's also a problem. So generally speaking, with contractors and construction, cash flow is king. You want a developer who's got enough float that they can pay a contract. If there's a delay in a drawdown or there's a cost overrun, that they can pay a contractor and keep the scheme going. By the same token, you want a contractor who's got enough working capital that they can continue to pay subbies, because a lot of people don't realise what a lot of contractors, what they are is effectively they are basically like another finance business. They are effectively they're effectively sourcing materials and labour on 30 to 90 day labour on, say, 30-day payment terms, materials on maybe 90-day payment terms, labour maybe on 30-day payment terms.
And then adding their margin.
Adding a margin, and then charging that 30 days later, charging that to the developer. So what that means is that contractor sometimes has to have a mismatch of timing between when they get paid and when they have to make payments. So as a consequence of that, they need to have a good degree of liquidity, right? Working capital and liquidity. This is why a lot of lenders are obsessed with a contractor's balance sheet. But that's all well and good. But just, by the way, which is great until it isn't, right? You could have a company like Carillion go bust, and they had a massive balance sheet until they didn't. So, but fundamentally, it's like, has the contractor got enough cash to pay for the materials and pay for the subbies, and then has the developer got enough cash to pay the contractor if there's an issue with their funding for whatever reason? Yeah. So those I would say are, it's all about cash flow.
I've got a small scheme on the go at the moment, and I can tell you now that there are these issues that even pop up on small schemes. Yeah. So we're just building 4 houses in Tunbridge Wells. It's not a massive scheme at all. But when you think about putting it in sort of layman's terms, if you think about installing kitchens, okay, we've got some kitchens that are going into this site where the units, the worktops, the appliances, they total to be just under 20 grand per kitchen. They're quite high-end kitchens, and they're done specifically to make the properties sell. But certain lenders, all lenders are different, right? Some lenders will treat this differently. The current lender on this site wants the kitchens in the properties before they'll release. So the QS wants to come and physically see the kitchens and then say, right, that kitchen's done. There's your 20 grand back for what you've spent. Now, if you think 4 properties, 4 kitchens, that's 80 grand. So if you haven't got that 80 grand up front, then you can't buy the kitchens, can you? So you need to have that cash flow to be able to say, right, there's the kitchens, I'm buying them all. And when you go and buy a kitchen from a supplier, certainly if it's a high-end kitchen or a decent kitchen that's being manufactured, it won't just be off the shelf. You might be able to get carcasses, but if you're having doors sprayed a certain colour or you want it there, and then there's the stone that needs templating. So these things take time, and you sort of think, well, I need my 80 grand back, but they're not installed, so you need to have that money. And the same thing applies to, say, timber frame. I could get your perspective on how this works from Avamore's perspective, but lots of lenders, they want the timber frame there, fully installed, so they can physically come and see it, and then say, right, your timber frame's here. Here's your 120 odd grand.
If it's not nailed, I think the traditional approach is if it's not nailed down, you're not getting a penny.
Yeah, and you can understand this. I mean, I've heard stories of developers, having multiple schemes on the go and using money from one scheme to spend on another scheme, and people have, you hear the stories that they've had a drawdown, all of a sudden a Lamborghini has been run through their business, and then the lender's saying, well, now you've not got any money to do this, and it happens. Some people are just very silly.
We've had serviced interest payments made to us, which have definitely been from development drawdowns on a completely different scheme. Like this, like that. Unfortunately, like we are at a point in the cycle where you're going to hear some horror stories. I mean, obviously I've given you one there, but I've given you one a few moments ago about this Israeli fund. But fundamentally though, there are ways around that. Like,
so for example, linking to the business bank account and monitoring what's actually going in and out. A lot of the lenders are now doing this.
You can do that, right? Yeah. But you can do that, right? But but at the end of the day, sometimes you don't. Sometimes it's also best not know. Sometimes it's best not knowing as well, because we've got a scheme again. It's shall we say, an interesting scheme, and it's a couple of accountants. It's in the northeast Midlands, large scheme. These people shouldn't really be anywhere near this development, frankly. But in hindsight, and they're accountants, and you see salaries for the accountancy practice coming out of the development company's bank accounts.
Yeah,
and you see the client trying to justify those people's salaries as genuine development expenses,
when they're not actually doing any PM or anything to do with the project, I suppose. So
you've got to look at that too. One of two ways. Like, if they try and claim that in a development drawdown, you just go, listen, no, you've got to be joking. This is not an appropriate development cost, right? I can't recover that cost if I have to enforce on this site. I can't enforce on Trevor's salary. I'd recover that as a genuine development expense. On the other hand, you've got to try and keep these developments going. Like, the number one priority is to get to the finish line when it comes to practical completion. And so the approach that you've got to take is one of pragmatism. So that is, okay, in the case of the timber frame, all right, we'll now have so the client wants to pay, has to put down a deposit for the timber frame. That's not a small amount of money, or steelwork, or kitchens, fill in the blank. Okay, fine. This is what we're going to do. We will have a direct contractual relationship with the supplier as the funder. So we'll do that extra bit of work. And again, this is one of those differences maybe between being a bank and being a specialist finance provider, is that you've got that ability to do that extra bit of work. That it's not that the people at the banks are lazy and aren't willing to do it. They just don't have, the capacity to do it. So we'll say, okay, fine, right, timber frame supplier, cool. You're going to contract with us, and you're going to covenant that you're going to deliver this timber frame and even install it for us if we have to. And you can do the same with the steels. You can still do the same with windows. You can do the same with cabinetry, whether that's kitchens or bathrooms. It all can be done in these ways that takes that de-risks it from a funder's perspective, but also helps the client from a working capital perspective.
I think it'd be very helpful for certain clients, certainly if they've had to put quite a lot of sweat equity into the deal in the first place. If they're, we've spoken quite a lot about cash flow. If they've got some money left in the business bank account and that gets their foundations done, and then they get their first drawdown, and then that next drawdown is used for the timber frame, they're always waiting for that next drawdown to continue. And sometimes you need a bit more than that. You need two drawdowns worth of a float in the account. Yeah. So being able to say, actually, look, I've just spent 40k to my timber frame as a deposit. Can we do this that you pay for it? And it makes a lot of sense, doesn't it, to just allow them to have a bit more cash, because there's a contingency, and all the lenders are different, but I'm seeing a lot of them wanting 10%. It depends on the site scheme and stuff. But so you've got that as a fallback, but you can't draw your contingency after the first month. The lender's not going to like that. They're going to want you to keep some contingency towards the end.
Can I also talk about something else that drives us mad when we see early drawdowns and blown up? I said blown up, but it was damaged relationships with borrowers. Quite substantially, and that is so you drawing on contingencies. That's one thing, but I'd be forgiving about drawing on contingencies early on if the client's actually cracking on and building. Where we go, what drives us mad is when we see claims for prelims and claims for professional fees. Basically, expenses, like from our perspective, what we've got to have in our minds is that if we have to take the keys back on the site and we have to stick that site in an auction, are we going to get the amount of money that we've advanced against the scheme, both against the land and against the build? Are we going to get that back? The thing is, prelims, like welfare facilities and all that sort of stuff, right? And fencing and, and by the way, it's all inflated and a lot of it's bollocks.
Yeah.
And professional fees, well, we're probably not going to be able to get a lot of that back from, if we were to enforce on that site, because an incoming buyer is going to be like, well, I've got to get another set of professional fees and another set of prelims on there. So it's of no value to them.
Yeah.
So that's why so I would also highly stress that if you are working with a development lender, you have to be very mindful about, especially us, you've got to be very mindful about the amount of prelims and professional fees and basically like what I would call non-hard build costs that you're spending on site. I'll be forgiving of contingency for actual hard build.
Yes, yeah. If you can see progress and then you can see they're 50% complete and they need 50% of the contingency, you can sort of say, okay, look, you've made an overspend on this and here's the reason why, or there's been this unforeseen, and you can accept it, can't you? So we've talked quite a lot about screw ups and potential developments that have gone wrong, and I suppose that for people watching and listening, there's been quite a lot of learnings there on what not to do, like checking costs and all these different things, not overpaying for land being the biggest thing. If we flip that now and say, right, we kind of know a little bit about what's your ideal developer, someone who's got a lot of experience, perhaps builder developer, but what are like the key attributes from your guys' perspective, when a developer comes to you, what are like the recipes for success rather than failure, would you say? Okay,
so I think recipes for success, and the current deal that we're working on is a quite interesting case in point, but is recipes for success are starting point, have a coherent plan, for the development. So, it's effectively, when we get presented with a case, it's essentially a business plan, but that is, do the GDVs stack up? Are the GDVs liquid? If you can't sell them, can you rent them out? And will you be able to refinance our debt on a buy-to-let loan? So these are good starting points. With the build cost, we talked about, right, if you're a self-builder, have you got your ducks in a row in terms of, we appreciate that you can't have every line item in your build budget squared off before you get started on site. And like sometimes you can't do, and sometimes it's not practical to do a soil investigation or ground investigation, right? But make sure that you've got, does your budgeting make sense? Have you squared off a lot of the big line items? So these are the things at the start. Have you got, solicitor, right? I know this is going to be music to your ears.
Yeah.
You cannot use Mr. Khan above Chicken Cottage, right? Who does resi conveyancing. You've got to use a specialist, someone who is used to dealing with specialist finance inquiries, because what happens is that a resi conveyancer will get a CPSE form from a lender solicitor. Now, most of the answers to the questions are not applicable, not applicable, not applicable, right? Or not as far as I'm aware, right? Those are the answers. However, when that lands on Mr. Khan's desk, Mr. Khan goes, fuck this. I'm getting paid 1,500 quid for this, but I'm getting 1,200 quid for a resi conveyance. Yeah. So guess what? I'm going to focus my time and energy on. I'm going to do the resi conveyance. Yeah. So that's why you need a solicitor on the borrower's side who is effectively a commercial property solicitor who knows what they're doing.
Otherwise, just don't bother. Really, truly. I mean, there might be a few residential conveyancing firms that have dabbled with a bit of property development or perhaps done some bridging, and they kind of have a bit of an understanding, but the majority of them don't. Yeah. And if you think that, so I suppose that's a really big learning point. If you've been doing buy-to-let, HMO, BRR, these types of things, and it's worked and you love your solicitor, that's fine, but that is not the same. So perhaps someone who's done some commercial conveyancing for you might be good, but you need someone who knows what they're doing. And perhaps you can say, have you done a develevent finance before? And just check that they know what they're doing. Because if they haven't, really just find someone else. It's not worth it. It'll just be a headache for you.
Yeah, I think a lot of the time people have this sort of, a lot of family solicitors have that sort of trusted advisor status, but that works until it doesn't, and unfortunately, like
until they get the list of inquiries from Avamore's solicitor, and then they go, "What is all this that they've?" Or do you allow them to dual rep? I don't know.
We'd love to. We would love actually dual rep, but our solicitors don't want our solicitors in the main. They want to run a mile from it, unfortunately. But
makes total sense. I can understand.
But and the irony is that we then get it in the ear from the broker a lot of the time, where they go, your solicitors, their requirements, they're too onerous, it's too much. Like they're not. But
I see that all the time. To be honest with you, the solicitor choices. So we've got solicitor's choice. We've got not overpaying for the land. Someone who really knows what they're doing is key.
Yeah. But that's not always the case, right? But if you're a less experienced developer, you then have to have a contractor.
That was my next question.
You need to have a contract. It doesn't have to be the biggest contracting firm, but it needs to be someone who knows how to work, who can work collaboratively with a bank's monitoring surveyor.
And so from your perspective, would you say the contractor being party to the loan and having a small shareholding in the deal is beneficial, or would you say it's best to not have that arrangement?
I've seen it work both ways. We've had one client who had that sort of arrangement with the contractor, but in the end the contractor sort of had them by the balls, and they got us out of the loan, but it sort of soured the relationship because he sort of almost expected us to try and fight on his behalf with the contractor, and ultimately, like our loyalty is ultimately to our funder, and we actually have to our first priority is to get the thing built and then to get everything refinanced. Like when our job is not to arbitrate between you and the contractor. However, I think in certain circumstances where you've got an inexperienced developer, the contractor, sometimes the contractor, because they have got some enhanced commercial arrangement with the developer, what that can do is what you can do there is we take a cost overrun guarantee from the contractor, which essentially means they don't have if our loan's for £2 million and we thought the site was going to be worth 3, and then when it's finished, but it ends up being worth 1.8. It doesn't mean that the contractor's on the hook for the loss, but the contractor's responsibility in a cost overrun guarantee is just to get the thing finished. That's an attractive thing from a lender's perspective, but it's not always practical. Like if you're a contractor and if there's not enough juice in it for you, why would you subject yourself to that? Obligation. So you have to look at each case as it comes from a lender's perspective.
Been amazing talking with you and getting your views from the funding side, rather than always how do we build this and how do we make money, but actually from your perspective, where are the risks and how to mitigate them as well. I like to always try and finish with a recommendation from the guest of some sort, if possible. So either a book that you've read, or another podcast, or perhaps a website that you use regularly. Is there anything that springs to mind that you could share?
Oof, wow. Well, I love my podcast, but I'll probably alienate most of your audience.
No, please feel free to share it. I'll put a link.
Talk about my favourite Arsenal podcast that I like to listen to. However,
that might alienate the audience. The fact that you support Arsenal, but we'll leave that one to the side.
Some of my best friends are Spurs fans, so I'm quite happy to offend everyone equally. I would say. I would say that I really like Modern Wisdom, Chris Williamson. I think that's it's probably a bit masculine as podcasts go, but I'm a big fan of that, and probably on a similar theme, Joe Rogan. But I do like Modern Wisdom. That's a great podcast. Recently, a few friends of mine have set up a book club, and so we've I really enjoyed a book called City of Thieves by I think it's by David Benioff, and so that's set in St. Petersburg in the Second World War, and these two thieves are tasked with going and hunting for a dozen hen's eggs, and they have a week to achieve it during the siege of Leningrad for the wedding of the colonel's daughter. So that was a good fun read.
Sounds amazing.
So I'd highly recommend that.
I'll put that in the show notes. Michael, thank you so much. I'd love to get you back in like a year's time and just catch up with you and see how things are going at Avamore. Congratulations for keeping a business going for almost 10 years, because I hear that's almost impossible. Similar to my business is coming up to 10 years in June 2015. And
Congrats.
I tell you, it's not been a small task. So hats off to you for doing that. And thank you so much for coming in and sharing all your wisdom.
No, and thank you, Omar. I think it's we've been speaking for a long time. It's good to meet you finally, and I think also again, these podcasts are great. It's important to get to share information and knowledge. There's a lot of people wanting to learn, and the more people that are sharing, free of cost, I suppose, business education. I'm here for it. It's why I founded the Property Funder podcast, and obviously very, very keen for your audience to come and jump on that. But, at the end of the day, it's the more we can share, the more we learn, the better we get.
For sure. Yeah. So I'll post all the details for Michael in show notes, including podcasts. He's also on Instagram, I think, as Property Funder.
At property_funder.
Yeah. Amazing. Thank you so much.
All right. Thanks, Omar.
Cheers.
Cheers.